Assalamu alaikum. Welcome to lecture 9 of ATX. So lecture 8 I have introduced you to CGT, capital gain tax. Now this is the continuation of it, the second lecture on CGT. In lecture 8 I have taught you how to compute CGT. Here it is variations to computations. So let us start. When we make a disposal between connected person, how the treatment should be. Then part disposal, chattels and vesting assets, leases, summary of variations to basic computations, compensation and insurance, and summary. So let us start with the overview. Connected person. Connected person means transfer between spouse or civil partners. Then part disposal. Sometimes we might make not a whole disposal, but maybe out of the asset, partly we might dispose and partly we might retain. So how to deal with it? We have to see whether it's a small part disposal or not. For that, we have some rules. Then chattels and vesting assets. What is chattels? I have explained to you in the previous lecture. Chattels are tangible movable property, and vesting assets like plant and machinery, leases, insurance and compensation. Okay. So in the previous lecture, I covered the formula of pro forma on how to calculate CGT payable, right? Here we are going to go in depth into some of these parts we are going to touch. Okay, the five areas, starting with connected person. So an individual is connected to his spouse, to relatives, or the spouse's relatives, or the relatives' spouses. Okay, and business associate, a company they control. All this are connected. Okay. Now, what is the term relative? Very important to understand. Relative means brothers and sisters, parent, grandparent, ancestors, children, grandchildren, and descendants. Term business associate means partners in business, a business partner's spouse, relatives of the business partner. So any transaction between these people, two siblings, spouses, business associates, are known as connected person. So when you are making a disposal to a connected person, this is the CGT implications. First, it is divided into two categories. One, other than spouse, like other relatives. The other one is just to the spouse. So it is, if the disposal is made to a connected person other than spouse, this is the consideration you have to use in the gain, market value. Okay. In my lecture 8, I have taught you that to calculate capital gain tax, the gain, you have to start with the consideration. What consideration you use depending on the condition. In lecture 8. Here, they are saying if it is a connected person other than spouse, consideration is equal to market value at the date of the disposal. Does not matter what consideration you have actually received. You might receive less or more, but market value at the date of disposal. And if it's a capital loss, let's say you are making a disposal to a connected person, let's say to your brother, and you have made a loss. You can only offset the current or the can only be offset against current or future gain arising from the disposal to the same connected person. Let's say you have made a disposal to your brother, you have made a loss. Now you can only offset that loss if you are making a gain. But from whom? You have to make a disposal to your brother, maybe a second transaction you're doing with your brother again, and you're making a gain. So only against that gain you can set off your loss, not to any other person. It has to be same connected person with whom you are doing the disposal in the future. Okay. Now, if it is transactions between spouses, remember this rule. Most of the time in ATX they give spouses. I've seen this in the past paper. It is no gain, no loss, transfer. That means the consideration has to be such that it will give rise neither to gain neither to a loss. The actual consideration could be anything. That means, so the transferor is therefore deemed to have disposed of the asset at his acquisition cost. Yes, because sale price, if it is equal to acquisition cost minus the acquisition cost, you will not have any gain or loss. Okay. Now, note, these rules only apply until the end of the tax year in which a couple are living together. If they are separated, rules will not apply. Now let's do a question. Test your understanding 1. So here we have 3 requirements, A, B and C. A, calculate chargeable gain if the gift of the flat. Please always understand the nature of the good. Is it a residential or a not residential? Because the capital gain tax rates are different. As I told in my earlier lecture, lecture 8, that for residential, lower rate is 18 and upper is 28. And for non-residential, lower is 10 and higher is 20%. So this is a flat. Tell me whether it's a residential or a commercial. We'll see. We have to read it, whether it is her own personal flat or any other. So he has bought a seaside flat in Cornwall for 23,600. She was to use when she was on holiday from work. The flat has never been used as Moses' main residence and does not qualify for furnished holiday accommodation. So it is not for commercial reasons, nor it is the main residence. That means the relief PRR will also not be there. So this is a residential. That means either it will be 18 or 28%. Okay. And it is the decided to give the flat which was worth 175,000. Now, tell me if the gift is gift to her sister and the civil partner. Calculate gain. B. Again calculate chargeable gain. Even C is calculate chargeable gain. Arising if the sister sells the flat for 200 and if the civil partner sells the flat for 200. Same date, everything amount is same. The only thing is person. The connected people changes. One is spouse, the other one is not spouse. That is only difference. So first we'll do if it's a sister, remember sister, no gain, no loss. So we have to decide the consideration at such level. What is the cost? What is the market value? 175,000, isn't it? So if it is to the sister, no problem. Actual market consideration we have to use. It is for civil partner, we have to use this. Okay. So the market value is 175,000. And deduct the cost. We bought it for 23,600. Very easy. Nothing to worry. So the chargeable gain, if it is to the sister, 151,400 normally. No issue. Coming to the second, if it's a spouse, what happens? You have to write no gain, loss transfer. Coming to part B. Remember, what is the sale proceed? 200,000 now. And deemed cost will be 175,000 for Motsi. Right? So she got it from Motsi. The sister got it from Motsi. Now the Motsi's sister's cost will be 175,000. So 200,000 minus 175,000 would be, the chargeable gain would be for the sister this time would be 25,000. This is very easy. Coming to C, if it's a sister, yes, 200,000 is the sale proceed, but what about the cost? Remember, it was no gain, no loss transfer. So his cost would be now her cost. Motsi's cost would be now the spouse's cost, 23,600. So the gain would be 176,400. And it would be taxed at the residential, 18 or 28%, depending on which band they are. Okay? Because it does not qualify as a main residence, he will not be qualified for PRR relief also. Private residence relief. Okay? Principal residence relief, I'm sorry. Now, tax planning. So, if you are a married couple, you can use NG/NL transfer, no gain, no loss transfer. We have just seen it in test understanding 1, right? This can save tax. Then, how to utilize capital losses? If it's a capital loss, remember capital losses you cannot transfer between spouses. Okay? So let's say where one spouse is making a chargeable gain and another spouse is making a capital loss. So better to transfer the asset or just say a part share in an asset before disposing it on a no gain, no loss transfer basis so that one spouse makes both the disposal and the loss can then be used to reduce the chargeable gain. Let's say the spouse who is having the gain, right? And one is having a loss. So transfer the asset first or a part of an asset to the spouse so that they can utilize their loss against the gain before you transfer among the spouses. That means before you transfer to your spouses in no gain, no loss transfer, make a transfer to the spouse so that the gain and the loss is in the hand of one spouse so that they can utilize, then they can utilize their gain against the utilize their loss against the gain. Because if one spouse is having a chargeable gain, another spouse is having a capital loss, okay, they can't utilize the loss against the gain. Both the gain and the loss has to be in one spouse's hand. That's why that transfer is necessary before you make a transfer on no gain, no loss transfer. Understood? Now, utilizing annual exempt amount. Each spouse is having an annual exempt amount of 6,000. Now, spouse can also utilize this transfer rule to ensure each spouse fully utilizes their capital losses brought forward from earlier years and annual exempt amount 6,000. Now, utilizing basic rate band. Basic rate is taxed at 10% in CGT and higher rate is taxed at 20%. Let's say residential property. Residential property, basic rate 18, higher rate 28%. Okay. Now, any taxable gain after you have utilized your capital loss and annual exempt amount, then couple can utilize the no gain, no loss transfer before the ultimate disposal so that whoever is paying the lowest tax, he and she has the gain. Understood? Then the gain will be taxed at a lower rate. So ensure that these gains, whether residential or not residential, are left with the spouse paying the tax at the lowest rate. So that it's better to pay at 10 and 18 rather than 20 and 28%. Okay. Now, you can even delay the disposal. This is called tax planning until the following tax year. How? You can save tax. Let's say current year, you have already utilized your annual exempt amount. Then delaying the disposal is good until the following year. Why? So that you can use the next year's annual exempt amount against that gain. And also you can save tax on a further 6,000 because annual exempt amount next year will be 6,000, right? So against that gain, you can deduct your 6,000 AEA. And if the individual is a basic rate taxpayer, then taxable income is lower in a subsequent tax year. Let's say you're a basic rate and your taxable income is lower in the subsequent year, it's better to delay that disposal in the next year. Next, so that you can utilize more of the basic rate band and your gain would be taxed either at 10 or 18%. Now, another advantage, first advantage was tax saving. Second advantage is cash flow advantage. You don't have to pay cash immediately. You can delay that payment of cash until the next year, right? That means, so gains realized on disposal up to and including 5th April 2024 are taxable in this year 23-24. And your capital gain tax has to be payable by 31st Jan 25, isn't it? But for disposal of UK residential property, that you don't have to pay by 31st Jan 25. The tax is always due within 60 days of completion. If it's a 60 days means 2 months. If it's UK residential property. Okay. So if you're disposing it, disposal, if you're making it even one day after, let's say on 6th April, you are delaying the disposal by one day. Not on 5th, but on 6th April 24 or even later, it's a good for you. Because then that disposal, that gain would be taxed in the next tax year. And even your capital gain tax, another 1 year delay. Now it will be payable by 31st Jan 26. Selling assets in tranches. You can sell assets in tranches, like shares. Rather than selling the entire share, you can split your assets and on a piecemeal basis you can sell. That means you are selling them in different tax years. This will help you to use more than one annual exempt amount. And also, overall total taxable gain would be lower. What is the impact on income tax on this? Remember, inter-spouse transfer of capital assets will not give rise to CGT. It is exempted. However, you have to see which assets are transferred between spouses. Why? Because if you are transferring a non-generating income assets, let's say paintings, endings, it will have no impact on the couple's income tax position. But if you are transferring income generating asset, then this will have an impact, like shares, letting property, because through them you generate income, no? Having shares, letting property, you generate income. If this you transfer, then this will result in the income being taxed on the recipient spouse in the future. You see? So the couple should ensure that asset generating income are owned by the spouse who are paying the lower tax. Income generating asset. Now, impact on income tax. Couple can jointly own the assets in equal or unequal proportion. But if it's unequal proportion, any income generated from jointly owned assets are divided 50-50. Unless couple makes a joint election that they want to be taxed on their actual ownership. There are exceptions. If it's a dividends from shares in a closed company, by the way, closed company in itself is a whole lecture. I'll be covering it when I'll be finishing corporation tax. Okay, it's a new lecture for ATX. We have a whole new lecture on closed companies. What is closed companies, features of closed company, and things like that. So for now, just very briefly, I'll tell you closed companies are family related companies, like who have like the company has very few shareholders. It's not a big shareholder, you know. So yeah, now, so dividends from shares in that closed company, which are always split on a beneficial ownership basis. And if it's an interest from joint bank accounts, it is always 50-50. This you have to remember. Now let us do question. Test your understanding too. So here you have to explain the tax planning measure you would recommend and taxation effect with supporting calculations. Remember, in ATX, tax planning question is a question which you can expect. Very frequently it will come. Definitely it will come. One question on tax planning. So here, Thomas owns a residential investment property. The moment you see residential, tax rate is 18 or 28. Okay. Now, that will realize a chargeable gain of 30. Sold in the tax year this much. Has a taxable income of 60,000. His wife, Vanessa, has capital losses brought forward of 11,800. Has a taxable income of 16,200. If you see, Thomas is a high rate taxpayer who does not have a capital loss. But Vanessa, on the other hand, has capital losses brought forward and also taxable income is just 16,200, which is at the basic rate. So here, one planning is to utilize the unused basic rate band and to utilize the capital losses brought forward. These are the two tax planning you can get. Okay. So first recommendations. I'm not writing it. Explain means you have to write. I will just tell you the points. First point. Because they're husband and wife. Okay. They should see whether they can utilize their annual exempt amount, both of them. Okay, so we'll talk about AEA, utilizing of AEA by both the spouses. So this can be achieved if one of them transfer some of the property to the other party before disposing it to the third party, doesn't it? The transfer between spouses is no gain, no loss. Okay, we'll see. If you see here, you see Vanessa as a brought forward loss, no gain, and a taxable income. So because she has a loss, she can't utilize her annual exempt amount. So one party, so Thomas could sell sum of the property to Vanessa, transfer. So because he has a gain, so his gain can be used to utilize her loss, and she also can claim AEA. So T to transfer to V, husband to wife. Okay. Now, so another basic rate band. Basic rate band, that is another planning we have to talk about, because Vanessa is having some basic rate remaining that can be utilized. Okay. So that means for Vanessa, she will be taxed at 18% because it's a residential property, and Thomas would be taxed at 28%. Now we'll discuss the with supporting calculations. We'll do the calculation and show. Okay, so first it is T, the husband, Vanessa, the wife. Okay, we'll write the chargeable gain. He has 30,000, whereas he has none, 0. Less AEA. 6,000 can be reduced from him, but nothing can not used. You can't write 0, but you are not using it. So 24,000. This is the current position, by the way. Always start with the current position even in your exam. Now, less capital loss brought forward. There is no loss. He doesn't have any loss, but for him, it is carried forward again because no gain this year. So after that, taxable gain. Is 24,000 and 0. Now, basic rate band remaining. How much? See, taxable income. This is taxable income. They didn't write trading income or anything. If it was trading income, other source of income, then only you have to deduct personal allowance of 12,570. Most of you make this mistake. This immediately, they see an income, they start reducing personal allowance. No, this is already, they have deducted the personal allowance if they have given you the figure. It's taxable income. Please read. It's taxable income, 16,200. So what is the basic rate band? 37,700. Remember, for capital gain tax and income tax, the basic rate band, higher rate band, the limits are same. Okay, 37,700 minus 16,200 is 21,500. He doesn't have anything, but for her is 21,500. So if you see 24,000 taxable gain, this would be taxed at what rate? 28%. Residential property at higher rate. And for Vanessa, it would be, this is 0. She has a taxable gain of 0 into 18%. So here it is 0. I'm sorry, this is not 0. 24,028. 6,720 and 0. So CGT payable. CGT payable. For the husband it is, that means for Thomas it is 6,720. Whenever it is 0. Now, Vanessa, she can receive gain. Okay, receives gain up to a certain amount and she will not be taxed. What is that amount? See, she has a capital loss of 11,800. That means she have not even utilized her annual exempt amount. That means she can have a gain of 6,000 plus her capital loss 11,800. That means 17,800. This much she can receive gain and pay no tax. Pay no tax, no CGT. Because whatever if she have a gain equal to 17,800, it will be deducted by the annual exempt amount of 6,000, capital loss of 11,800, and ultimately CGT would be 0. And Also, because what is the basic rate band? 21,500. A further 21,500 at 18% will be charged at 18%. Okay. Now we'll revise the position. Remember, we did revised position. Now TV, chargeable gain. Okay. How much should be the chargeable gain? How much T should transfer to V? Do we know that? How much gain? This is very important. How much gain is he making? 30,000. And how much annual exempt amount she's utilizing? 6,000. So that means his gain has to be up to 6,000 so that he can fully utilize the annual exempt amount and bring down the gain to zero, taxable gain. But for Vanessa, okay, so chargeable gain for T should be 6,000 because which will anyway be utilized by annual exempt amount of 6,000, bringing it to zero. And of course, there are no capital loss brought forward, so taxable gain is zero. But for Vanessa, from 30,000, earlier chargeable gain for T was 30,000. Out of that, 6,000, let T use 6,000, let remaining 24,000 be transferred to Vanessa. Now she will also have an annual exempt amount of 6,000, which is 18,000. What is the capital loss? Brought forward loss? 11,800. That also she can utilize. And she'll be left with a taxable gain 6,200 and 0. Now this 6,200 would be taxed at 18% because she is a basic rate taxpayer. 1116. This is the tax. How much is the tax saving? See, it's only one tax. 6,720. Now it is 6,200. Now this is the tax. I'm sorry, 6,720 and this is the tax. So 6,720 was before. Now the revised position is this. So the tax saving is 5,604. This is tax saving. This you have to calculate. Remember, there is an alternative calculation to this. This alternative calculation should be used in your ATX exam. This is a long method and it's very time consuming. Rather, use shortcut wherever you can in ATX, especially wherever you have tax saving and all. Okay. So now, how much? There are two benefit. Understand this. Two benefit. One is tax saving because of remaining gain taxed at lower rate. The other one is utilization of one assets AE and capital loss brought forward. There are two. I will write it. Utilization of Vanessa's annual exempt amount. Earlier she couldn't use. Now she can use annual exempt amount. That is one advantage. And the other one is capital loss brought forward. Utilization of this. So from this there is a tax saving. One tax saving is this. Okay. Calculation I will show you a little bit later. Other benefit is remaining gain. Because she's a basic rate. Now remaining gain taxed at lower rate. Rather than 28, it is being taxed at 18. This is another benefit. Here also we have a tax saving. So we'll add both the tax saving. See here. This one. Look at the reverse position of Veneza. Veneza is having a gain of 6,200, isn't it? So this gain, earlier she did not have any gain, but now she has this gain. This will be taxed at, she'll be saving a tax at, earlier this 6,200 before transferring. See, before T transferring the asset to V, husband transferring it to wife, this 6,200 was in the hand of whom? Thomas. Thomas was paying at what rate? 28%. Now, because it fell in the hand of V, how much tax is saving? From 28 to 18. Tax is being taxed at a lower rate now. Earlier, you see in the earlier scenario, the taxable low. That means that 6,200 was here, included here, taxed at 28%. Now, 6,200 came here and it is being taxed on Veneza at 18%. So the difference from 28 to 18, that is tax saving. That's it. That is what we are doing here. 6,200 into 28% minus, always find the difference between the tax rates. 620. This is tax saving. First one, utilization of annual exempt amount and capital loss. What is the annual exempt amount? 6,000. What is the capital loss? 11,800. If you add, it would be 17,800. This would be taxed at what rate? How much tax you are saving? 28%. How? Because earlier, what happened? If you see here, when it falls in the V's hand, okay, both capital loss of 11,800 and 6,000. This you were not able to utilize before because there was a loss. So earlier, this is at 28% straight away. How? Because if V receives this gain 17,800, up to this much gain if he receives, she pays no tax. No tax at all. But it is in the hands of whom? This 11,800, okay, was not being utilized before. If it was utilized also, it should have been utilized by whom? Thomas, because he has a gain. First you have to transfer it to Thomas, then Thomas has to utilize it. But Thomas is a high rate taxpayer at 28%. Understanding? So if it goes in the hand of Thomas, Thomas will be paying at 28%. That's why now that 28% you are saving entirely. So it is 4,984. If you add, it is 5,604. Isn't this and this the same? But this is more shortcut. I know shortcut is little difficult, tricky rather than the long method, but this is, trust me, it really works. It does magic. Okay. Why 17,800 and 28%? This part I will explain again. I know it's a bit confusing. This 17,800 gain is in the hands of Thomas currently. Because Thomas is the one who's having the gain. Vanessa is having a loss. She can utilize her annual exempt amount also. She can utilize her capital loss also. So once the gain is transferred, that gain of 17,800 comes to her, she can utilize her annual exempt amount also, CGT also. But he was a 28% taxpayer. So he's he earlier was having this 17,800 in his hand, which was taxed at 28%. Entire amount when it comes to V, it is saved because she doesn't pay any tax. V doesn't pay any tax. Why? The 17,800 gain would be first reduced by 6,000 annual exempt amount, then by the capital loss 11,800, and no tax. So entire, so it is not the difference 28 and 18. No, it was not like earlier T was paying, now V is paying at this rate. No, 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 no. That is happening here in the second scenario, because earlier it was being paid at the higher rate. Now it is being paid at the basic rate taxpayer. We know by looking at this. Look at the current position. Who is paying the tax? V. Sorry, the husband at higher rate. Now scenario changed. It is the wife, Vanessa, is paying, while husband is paying 0. So from 28 to 18. That's why this tax saving, the basic rate ban, right? This. But here, when it comes, the entire 28% is saved. It's not 28 minus 18. No. Because Vanessa is not paying anything at all. Now. So that's why it is this. Okay. So now we are moving on to part disposal. In part disposal, the allowable expenditure. Now, this is how you work out the allowable expenditure. Cost into A divided by A plus B. A is the gross consideration of the part disposed of. B is the market value of the remainder at the time of the part disposal. So the appropriate proportion formula is applied to the original cost, including any incidental acquisition cost, and also the enhancement expenditure, where the enhancement applies equally to the whole asset. If the enhancement relates to the part disposed, deduct in full in the part disposal. If it is wholly to the part retained, do not deduct any in the part disposal. So if you are the enhancement expenditures related to the part disposed, then only deduct. If it is to the part retained, do not deduct. Now, small part disposal of land and buildings. How do you know when it is small? You have to look at the proceed. When the proceed that you have received are small, then a part disposal gain arises unless an election is made. You can make an election. The effect of making the election is this. If it is small, you can say the proceeds are small. So you can say that there will be no part disposal at the time. The gain will be deferred until the disposal of the remainder. And the gain that is deferred by deducting the proceed received on the small part disposal from the original cost of the asset. This is how you defer the gain. How do you do it? Whatever the proceed you receive from the small part disposal, you deduct the original cost of the asset from that. Now, sorry, from the original cost of the asset, you deduct the proceed. It's the other way around, I'm sorry. Now, what about the part retained? There would be some cost to it, no? So the base cost of the part retained is therefore reduced. And the gain arising on the subsequent disposal of the remainder will be higher. You will see this through a calculation, otherwise you will not understand. Whatever is remaining, remember, even if the gain is deferred, you might think you are escaping the tax. No. Later on, when you are disposing it, that time gain will be higher. Subsequent disposal gain will be higher. So ultimately, not now, but later you are paying a higher tax because gain is higher that time. How? Because from the original cost of the asset, you are deducting the proceed. So when you're deducting the proceed, what happens? The cost reduces, no? The base cost of the part retained is therefore reduced. So because the cost reduced, later when you're disposing from that proceed, now you are reducing a lower amount of cost. So if you're deducting a lower amount, gain would be bigger. Gain bigger means you have to pay higher tax. Now, definition of small. When proceeds, this is only for part disposal. If you're entirely disposing it, that small disposal will not come. If it's a part disposal only, you have to see whether a small is there or not. If less than 20% of the value on the land and buildings before the part disposal. That means value of land and building are less than 20% before the part disposal, and means both condition has to be satisfied, and total of all the land sales in the tax year is less than 20,000 in that one tax year. Total of all the land sales, you can have 5 land sales in that tax year. If you accumulate all, should be less than 20,000. Now the next is chattels and vesting asset. Before we start this, let us do question on part disposal. Test your understanding 3. So in test your understanding 3, two requirements. One, we are making an election to defer the gain on the part disposal. B, election is not made. Under both, we have to calculate chargeable gain. So this is about a 5-hectare plot of land for 30,000. Sold 1 hectare for 9,500. Remaining 4 hectares were worth 80,000, and sold the remaining 4 hectares for 135,000. Now, first with election, second without election. So we'll see with election. That means to defer the part disposal gain. Okay. Now, first understand how much the whole 5 hectares is worth. Very important. Okay. So the whole 5 hectares are worth how much? This is for 4, and this is for 1. Okay. So it is 80,000 plus 9,500, which is 89,500. This is for 4, this is for 1. Now you have to see how much, whether the proceed is less than 20% or less than 20,000 or not. Sorry, it's an and. It has to be less than 20% of this value and less than 20,000. Okay. So if you take 20% of 18, and this is how you have to do. Always you have to take the whole thing before and after. So before the 4 hectare, the remaining is 80, and you have sold 9,500 for 1. Add the total is 89,500. Take 20% of it, which is 17,900. If you see 17,900, how much did you receive for 1? 9,500. So this 9,500 is less than the 20% rule. Okay, one condition is satisfied, and 9,500 is less than 20,000 also, and both the conditions are satisfied, so you can defer the gain. Okay, so you can make to defer the gain. So this time when you are making the sell, when you are selling the 1 hectare of land for 9,500, no gain will arise. So now you have bought a 5-hectare plot of land for 30,000. Okay, no gain will be there. Now what about the remaining? The base cost of the remaining 4 hectares now becomes, remember you have to reduce it by this, the sale proceed. What is the cost of the 5 hectare? 30,000. Okay, so from 30,000, now we'll take 9,500 out, the proceed. So now the base cost of the remaining 4 hectares will be 20,500. Now when we are making this disposal of 135,000 in September 2024, we'll need this 20,500 that time, because that time will reduce this 20,500 by that sale proceed. 135,000 minus 20,500. This is the amount we have, the remaining, for the remaining 4 hectares, this was the cost, base cost, that will deduct from. Why? Because on this date we have sold the remaining 4 hectare also, so we have to deduct the cost from the proceed. 114,500. This is the chargeable gain, CG. Now assume no election is made. Then you have to do a part disposal. How much did you sell 1 hectare land? 9,500. We have to do that A divided by A plus B, part disposal. We have to find the cost of 1 hectare. Because we have sold 1, so we have to find the cost for 1 only out of the 5. Okay, so how are we going to do that? The cost of 5 plot is given 30,000. This is the out of that we have to find only for 1. So 30,000 is the cost into, what is it for 1? 9,500 divide by 9,500 plus, this is for 1. Remember, for 4 it was 80,000. Isn't it? They have given here. The remaining 4 hectares were worth 80,000. And for 1 it was 9,500. So out of the total, you have to do this A divided by A plus B fraction. And if you do it, it would be 3,184. This is the cost you have to deduct from 9,500. That means now you will be chargeable 6,316. This is your chargeable gain. Now when you're disposing it, September 24 disposal, what is the sale proceed? 135,000. This time you deduct what? What do you deduct? No. You from 30,000, that was the cost for the entire 5. Out of that, the cost of 1 hectare was this. This is now we have calculated. Don't deduct 6,316. No, we didn't defer the gain. We found the cost for 1 hectare 3,184. For the 5, it was 30,000. So from that 5, take the cost of 1 out. 3,184. 26,816. It would be 108, 184. This is the chargeable gain. This is the chargeable gain. You see? Remember, you will get the same gain as this 114,500. I can prove it to you. How? Because you are only deferring the gain, no? Here, this time you are paying this amount, later you are paying this amount later. But in the first scenario, when you are selling 9,500, that 1 hectare land you are not paying any tax. Rather, the entire 114,500 you are paying September 2024 when you are disposing the entire land. So just add this to 18,184 plus 6,316. It would be 114,500. Only the timing of tax change, everything remains the same. So whether this differing, you might say, then what is the benefit if it's the same tax? See, this is differing of tax. Whether it is beneficial or not, we don't know. We don't have any information. We don't know the tax position. We don't know whether they are using their annual exempt amount or not. We don't know what are the tax rate, whether they are basic rate or higher rate. We don't know. If we would have those information, then we could say differ or don't differ. Okay. So now, chattels. Chattel is tangible movable property. Chattel could be could be vesting assets. Vesting means those assets which have a predictable life less than 50 years. Or it could be non-vesting. Non-vesting means more than 50 years. What are the consequences? Vesting chattels and non-vesting chattels. If it is vesting, expected life is 50 years or less. Non-vesting, expected life more than 50 years. Examples: racehorse, grey house, boat caravan. Example: antiques, jewelry, paintings. Then, vesting chattels exempt. Exception are plant and machinery. If it's plant and machinery, it is not exempt. Non-vesting chattels, if it is bought and sold for less than 6,000, exempt. If bought and sold more than 6,000, chargeable in the normal way. Now, vesting chattel, less than 50, 50 or less than 50. Vesting assets can be split into three categories. First category, chattels that are not eligible for capital allowance, exempt from CGT. Chattels which are eligible for capital allowance, plant and machinery. Other vesting assets. So we'll go through one by one, starting with plant and machinery. This is always deemed to be a vesting asset. It is sold at a gain than normal. If it is sold at a loss, no gain, no loss. Why? Because you will be given a relief. You will be given capital allowance on that plant and machinery. Now, other vesting assets. This category covers vesting assets which are not chattels. That means they might not be tangible. They might not even be movable also. Remember, chattel means it's tangible and movable. If it is not chattel, it is not movable, it is not tangible. It could be intangible also, like immovable plant and machinery, copyright, license. So, the allowable expenditure for this type of assets, it is very simple. Look at the life of that intangible asset, and allowable expenditure will be based on that life of the asset. It's on a straight line basis. Let's say intangible asset is for 5 years. So the allowable expenditure will be spread over 5 years. Or if it's leases like that. Now, so when you are making a disposal, the allowable expenditure is restricted to take account of the asset's natural fall in value. And assets fall in value is deemed to account on a straight line basis over its predictable useful life. This is same like depreciation. Now, allowable cost. This is how you calculate. C less P divided by L into C minus R. Didn't understand anything? Don't worry. Where P is the disposer's period of ownership. How much that is the period of ownership. P, that's why it's P, period. How long are you owning that asset? Next, L is for the asset's predictable life. Let's say it's 10 years. One is how much you are owning that before you're disposing. The other one is assets overall life. Understood? Then C, cost of the asset. R, residual value. Now, let us do a question. Illustration 1. Illustration 1, we have to calculate chargeable gain or allowable loss. A, asset is a vesting asset, sold for 34. Asset is plant and machinery, eligible for capital allowance, sold for 34 again. C, asset is plant and machinery, again eligible for capital allowance but sold for 63. So here he had bought an asset, cost is 45, useful life is 25, scrap value 6,000. Okay, so first one, asset is a vesting asset. If it's a vesting asset, remember, we have to see the useful life and all. Over the useful life, we have to do it. What is it? We have sold it for 34,000. Sale proceed is 34,000. Cost we have to find out. Okay. It's like how we deduct depreciation from the non-current asset cost. So from 45,000, okay, we have to deduct vested cost. Vested cost would be useful life is 25 years into what is the cost? 45,000 minus scrap value 6,000. Here, what is the life the disposer is holding the asset? Bought an asset on 16 March 2016 and selling the asset 24. So 17, 18, 19, 20, 21, 22, 23, 24 for 8 years. So it's 8 years. And if you get it like this, so from 45,000, it's 12,480 you have to deduct. Once you deduct that, this is the allowable cost, 32,520. Deduct from the sale proceed and get the chargeable gain, 1,480. This is the chargeable gain. Very easy. Coming to the second one. When it is eligible for capital allowance, how much? Again, the cost is same. But if you see, you have bought it for 45, right? Just check the loss. It's 34,000 minus 45,000. If you see, there is a loss of 11,000. But because it is eligible for capital allowance, okay, it would be capital allowance will be given equal to 11,000. You see, machinery was sold at a loss for 11,000. This will be compensated by giving them capital allowance. So now, how this will be done? Sale proceed 34,000. What is the cost? 45,000. Deduct capital allowance from the 11,000, which is 34,000. So that means it would be no gain, no loss transfer. You see, it is zero. There is no allowable cost, it is zero. And the third scenario, sold for 63. Because it is 63, normal gain computation. So 63,000. What is the cost? 45,000. It is 18,000 is the gain. This is normal. You might be thinking that here even this is eligible for capital allowance. Then why? See, when we are selling it at a profit, automatically, if you know the capital, if you have watched my capital allowance lecture, capital allowance is designed in such a way that whatever 11,000 was given to you before when you were making a loss will be claimed. Okay, whatever the capital allowance you got before, now they will claim it back from you. How? HMRC will claim it back from you through a term known as balancing charge. When you're disposing, remember, in capital allowance computation, if you're disposing, there'll be a balancing allowance or charge. Balancing charge if sale proceed is more, like this. So through that balancing charge, you will anyway have to pay tax on it. You see? So by balancing charge, they will take out that capital allowance from you. That means you will not have any capital allowance left with you. That's why we deduct the cost from the sale proceed, even though it is eligible for capital allowance, because it's a normal situation profit. And if it's a loss situation like part 2, then we take capital allowance from cost, deduct from sale proceed, no gain, no loss. This is how it always works like this. And the first scenario, nothing to do about capital allowance, it's a vesting asset, take the useful life and deduct like that. Leases. There are two situations relating to lease that will be asked on your exam. Number 1, long lease. Number 2, short lease. And assignment of a lease means complete disposal of the leasehold interest in the property and is usually by a way of a sale or a gift. So you might gift a lease to someone or you are selling the lease. And it's a complete disposal, not part disposal when it's a lease. Okay. Now, if it's a long lease more than 50 years, short lease less than 50 years, 50 or less than 50. Okay. So normal gain for long lease and for short lease 50 years or less. And this is a disposal of a vesting asset. Okay. We have done a question on this previously, 8 divided by 25. Now, you have to take an allowable expenditure. You have to adjust it to take the account of depreciating nature of the asset. Cost is multiplied by the fraction. This is how you do it. The percentage for life of the lease left on the disposal date divided by percentage of the life of the lease left on acquisition. That means from the date you are disposing, how much time is left for the lease to get over. And the denominator, from the date when you first entered into the lease, what is the lease period? Now, if required, HMRC's lease depreciation percentages will be given in the examination question. Now let us do question on this. Test your understanding 4. You have been given the lease percentages for 40 and 39 years. Now, there's a lease, sold a leasehold shop for 90, acquired it for 50. It has 40 years to run. But remember, they have bought it on this one and on this date is the year is 39 years. 1 year it reduced. Calculate chargeable gain. So first is the sale proceed, 90,000. No issue with the sale proceed. Problem comes with the cost. So that 50,000 cost percentages has been given to you. Okay. So for 39, 94.842 and divide by 95.457. Okay, that is the percentage for the 40 years. So now let's do it. It is 49,678. Deduct from the proceed. That would be the chargeable gain. 4322. Very simple, right? Now let us move on. Next is lease percentage calculation. Now, length of the time remaining on the lease at the time of disposal and acquisition is very straightforward to calculate. Two situations. Number one, where there is an option to terminate the lease before the expiry date, end of the lease is taken to be the earliest date when that lease will be terminated, either by the landlord or by the tenant, doesn't matter, whoever has the option to terminate the lease. So we'll take that as the lease period whenever lease will be terminated. Next, length of the time remaining on the lease may not always be a whole number of years. If this is the case, calculation has to be performed to the nearest month, and you have to depreciation in between each year is deemed to occur on a straight line basis. 1/12 of the difference between the percentages for the years either side of the actual duration is added for each extra month. That means let's say 38 and 39, and it's 38.5. It's between 38 and 39 years. More than 38, less than 39. So what do? You get the 1/12 of the differences between the percentages of both 38 and 39. Okay. This 1/12 you will take for each extra month. Let's say it is 38 years, 6 months. So for each month, you will take this difference and add it. We'll see through our calculation how to do this. Test your understanding 5. You have been given 3 years percentages, 42, 43 and 48. Now, purchased a lease for 48 years, okay? With 48 years to run on 1st September 2018 and sold the lease on 28th Jan 2024. Sold the lease for 75 and bought it for 62,000. So you just have to deduct the proceed from the costs. Proceed, no issue, but with the cost, there is a work to be done. So first we'll do the working. Remember, from the date of the purchase, 48 years are remaining. But what about from years left to run at disposal? It starts September 2018 to 28th Jan 2024. So if you take like that, okay, 19, 20, 21, 22, 23, okay, it is 5 years. And see, from 1st of September 2018 till 31st August 2020, sorry, not 20, 23, three 2023, because on 20th Jan 2024 it was sold, just 1 month. So from here to here, just take the exact years. How many years? 19, 20, 21, 22, 23. 5 years, isn't it? 5 years, exact 5 years, and add the months from September to Jan. September you have to count the whole because it starts from 1st September, but for January it's almost towards the end. So we'll take the whole of the Jan, not 28 days. We'll take in nearest month. So September, October, November, December, January, 5 months. So it is 5 years and 5 months. But it is Duration, see duration from 48, it runs from the date of acquisition. Okay, from this date, 1st of September 18. But from this date, when you are selling it, this have to be deducted. Years left to run at disposal. You need to deduct this 5 year, 5 month. From 48 years. From 48 years you have to deduct. Then it would be 42 years and 7 months. How? You might be questioning this. Basically 5 years, 5 months you minus from 48. If you do it, it will be 42 years, 7 months. How? 7 plus 5 is 12 months. That will give you 1 year, 1 additional year. And 42 plus 5 is 47. So 47 plus 1, 48 years. It's adding up to 48 years. Okay? It's a little bit tricky, might look like, but if you keep on practicing, you will get it. So it's 42 years, 7 months running. Okay? So for 42 years, 7 months, what do? You need the figure of 42 also. You need the figure of 43 also because it's in between, no? But there are 7 months to it. So let's do this calculation. Okay? So here, remember with 42 years plus 7 months, you are adding 42 years, okay? Not the 43 years. It has to be less. So it is this 96.593. Just take out the percentage out and just put the numbers, okay? 96.593, because it's easier to work with the numbers. If you put the percentage, you will get confused. 96.593 plus 7 divided by 12 into what is the 43 years? 43 you have to minus from 42. It's always like this. 1 year before and 1 year after you have to minus. So 97.107 minus 96.593 would give you a figure of 96.893. Make sure that you are getting it. Okay. Make sure this multiplication part is done first and then the addition. Okay. BODMAS is very important. You first have to multiply and then add. So now you have to use this in the figure. 96.893 because 42 years, 7 months, and 44 years, the figure is given 99.289 is here. And take the cost. Cost is 62,000. Deduct it from the sale proceed. So we have sold it for 75,000 and this would give you 6504. So 6504 would give you a gain of chargeable gain of 14,496. Now the summary to basic computations. So we started with transfer between spouses, no gain, no loss transfer. Then we started with part disposal. The allowable cost will be cost into A divided by A plus B. A is the market value of part disposal. B is the market value of the remainder. Enhancement expenditure also we find the allowable cost. Okay. Deduct in full if it's for disposal part and do not deduct if it's for the retained part. And if it's a whole asset, a portion per formula. If the enhancement expenditure is for the whole asset and you have to you have to see which part is for the disposal, which part is for the retain, You have to apportion per the formula. Which formula? Cost into A divided by A plus B. The one which you have used for allowable cost above. Then we have to see whether the disposal is a small part disposal of land or not. It would be, if it's small, you could elect. What could you elect? To defer the gain. How? By deducting the proceed from the part disposal from the original cost on disposal of the remainder of the asset. When you're disposing the remainder of the asset, that time you are going to deduct the sale proceed that you are getting now from the original cost. Next, chattels. Vesting chattels are exempt. Non-vestings normally you have to compute. Now, plant and machinery, if it's movable, treat as non-vesting chattel. If sold at a gain, normal. If sold at a loss, no gain, no loss, because you'll be given capital allowance. Vesting assets like copyrights, see, they are not, they might be unmovable or immovable or not tangible. Like copyrights is an intangible asset. So allowable cost is like this. It's more of like a depreciating nature. C minus P divided by L into C minus R. C is the cost, R is the residual value. P is the proportion that the disposer is having the asset, and L is the life of the asset. You have leases, long lease and short lease. Long lease normal computation, that means more than 50, short lease is 50 years or less. Allowable cost, you get like this. Take the lease percentage at disposal date, divide by lease percentage at acquisition date. Now, last part, compensation and insurance. This is a capital transaction. Okay. Let's say when an asset is damaged, destroyed or lost, what happens? Owner receives a compensation, usually from an insurance company. Then, here what happened? Owner has received a capital sum, but they did not dispose any asset. They have received nothing in return. So that's why there are some special set of rules for it. And this will vary according to whether the asset has been completely lost, destroyed or damaged, or whether the proceed that you have received from insurance you have used to replace the asset and get another asset like in that place. Now, this is the chart. First, there are two parts. One part will be discussing when the asset is lost or destroyed. In the other section, when the asset is damaged, but not lost or destroyed. If the asset is lost or destroyed, we'll see whether we have received the compensation from insurance or not. If insurance proceeds are not received, normal CGT computation, no sale proceed unless scrap value received. And deduction of allowable expenditure will create an allowable capital loss. Okay, if insurance proceed is received, you have to see the date of disposal. The date insurance proceeds are received, that is the date of disposal. It is not the date of your destruction or loss. It is the date when you are receiving the insurance proceed. Then you have to see proceeds are reinvested in replacing asset or not. If they are not reinvested, normal capital gain computation. If they are reinvested, proceeds are reinvested and asset are replaced within 12 months, it's a partial reinvestment. You have to see whether it's a full investment or partial reinvestment. If it's a partial reinvestment, if it's a full reinvestment, no gain, no loss. You can elect for no gain, no loss. Because you have reinvested fully. So you are saying you will not pay the gain. Like you will not be taxed on the gain. You can fully defer the gain. But if it's a partial reinvestment, remember, some partially you will be taxed now, partially later. That means partially you can defer the gain. So amount chargeable now would be lower of the gain and the amount of insurance not reinvested. And after that, rolled over the remaining gain. If you are very well aware of rolled over relief, that's how it works. Now let us do a question on this. So we are going to do 3 questions. Illustration 2, illustration 3 and test your understanding 6. All discussing asset destroyed. Illustration 2, calculate the allowable capital loss. Purchase a capital asset for 15,000, got destroyed by fire, receive scrap proceeds of 1,000. Asset was not insured. That means you have received nothing from the insurance. So it's very easy. Just deduct the scrap proceed and the cost. So there's a loss of 14,000. Allowable loss is 14,000. Now, Let us go to the illustration 3. Assuming the bill claims the loss by fire to be a no gain, no loss, calculate allowable expenditure of the replacement asset. So purchase an asset for 25, destroyed by fire, scrap wood is 1000, compensation is 35,000. Out of it, he purchased a replacement asset for 40,000. That means the entire amount of insurance you have used. You see, it's not a partial, it's a full reinvestment. So the cost of the replacement asset is 40,000. From this 40,000, you can deduct the gain. What is the compensation? 35,000. From that 35,000 scrap proceeds you will deduct, which is 36,000. And from that, cost of the old asset will be deducted, which is 25,000. This is how you always work out. And then you will be having a replacement asset base cost as 29,000. This is the replacement asset base cost. Okay. Because the question asked you calculate the allowable expenditure, the base cost of the replacement asset. They didn't ask you gain or loss. Anyway, it's no gain, no loss. Question tells you that like that. Okay. So as you can see here, this is the answer. Now coming to test your understanding 6. Assume Belinda claims the loss. No gain, no loss. Calculate chargeable gain arising on the sale of replacement necklace. The replacement asset she's selling this time. Necklace was bought for 21,140. It got lost. Receipt compensation of 45,000, and she purchased a replacement necklace of 50,000. That means entire amount was used. Now she sold it also for 65,000. What happened? Remember, always whenever you are disposing the replacement, first you have to find the replacement asset base costs. Otherwise you can't find the gain when you're disposing it. So this is how you find. First you get the cost of replacement asset, not the original necklace. 50,000 is the cost. Then what is the insurance proceed? Check the insurance proceed. 45,000 you have received. From here you will deduct what? Base cost. What base cost? This amount, this entire amount. This you will deduct from the proceed. 21,140. 23,860. So you will be having 26,140. This now you will deduct from the 65,000 gain. So 65,000 minus 26,140 would give you 38,860. This is the chargeable gain. Remember, always see the question is asking you the chargeable gain or replacement asset base cost. Sometimes most of the students often find chargeable gain when the question is just replacement asset base cost. To find the chargeable gain, you have to find this. It comes under working. Okay. Now, asset is damaged but not totally destroyed or lost. In the first scenario, we studied when asset is destroyed or lost and we receive insurance. Now asset is damaged. Here, when an asset is damaged, there are no implications for CGT unless you receive a compensation. Where an asset is damaged and you are receiving a compensation, this is a part disposal for CGT purpose. Okay. However, you have to see whether the insurance proceeds are used to restore the asset or not. Same like how we have replaced the asset thereon. So if asset is damaged, if no insurance proceeds received, no chargeable disposal. If insurance proceeds received, yes, it's a chargeable disposal, but part disposal. Remember the part disposal for land? Same here. A divided by A plus B into cost. A is the insurance received. B is the value of the asset in its damaged condition, not good condition, damaged condition. Remember your A's and B's always. You can make an election. If the asset is non-vesting, insurance used to restore the asset. Remember, non-vesting means what? What is vesting? You can't forget all these terms when you come here, okay? So in case you forgot, go back to my lecture and check what is vesting, non-vesting and all. Okay, when an asset is non-vesting and insurance used to restore the asset, then you can make an election. You have to see whether 95% or more of the insurance are used to restore the asset or less than 95% are used. If more than 95%, 95% or more of 95% of insurance are used to restore the asset, it's a normal part disposal unless you elect to defer the gain. If elect no part disposal, deduct the insurance proceed from the cost of the restored asset, like how there you have deducted from replaced asset. If less than 95% of insurance are used to restore the asset, it's a normal part disposal unless you make an election. But this election will not be asked from your exam. It's only when it's 95% or more of insurance that you can elect. But if it's less than 95% of insurance that are used to restore the asset, election part will not be asked from you. So it's a normal part disposal. Now let us do questions when an asset is damaged before we summarize this lecture. Illustration 4 and illustration 5. Okay. So in illustration 4, the answer is already given, but let's see how we got it. Calculate the gain. Here, Sasha purchased a painting for 10,000. Painting was damaged when it was worth 50. After the damaged paint was worth 25. Insurance proceed was 30 and it was not used to restore the painting. Okay, so because it was not used to restore the painting, we don't have to see whether we invested more or less than 95%. That part we don't have to see. Okay, so it is normally a part disposal. So the sale proceed is 30,000 here and it's a part disposal. It will be A divided by A plus B. A is the cost. So we purchased the painting for 10,000 and then insurance proceed that you have received is 30,000. This 30,000 divided by 30,000 plus painting when it was damaged was worth 25,000. That's why we added 25,000. We got the cost, deduct from proceed and got the chargeable gain. Okay. Next one, we have invested the insurance proceed. We'll see whether it's less or more than this one. So calculate the revised base costs. See, they asked revised base costs. They didn't ask CGT. After it has been restored, assuming they elect for the insurance proceeds to be rolled over against the cost of the painting. So it was purchased for 10,000, damage 50, worth after damage is worth 40,000, proceed was 8,000. All of the proceeds apart from 300 were used to restore the painting. Remember that 300 you can't roll over. So we have to see whether, okay. So now, as more than 95% of the proceeds are used to restore the asset, and even Ella has elected the process to be rolled over, there is no part disposal. Okay, and you have to find the revised base costs. How do you know that? Just check. In case you want to find whether it's more than 95% or not, just check. 300 you can't use, but 8,000 minus 300, 7,700 and 8,000. If you take 7,700 of 8,000, it would be more than, because that much you have used to restore the asset. That much of the insurance proceed. It is 96.25%. This is more than 95%. And you have elected to roll it over. So you have to find the base cost of the painting. So the original cost is 10,000. You deduct the insurance proceed of 8,000. $2,000 and you add this, that is the cost of enhancement That means you have used to restore the asset. Out of 300, from 8,000, you have only used 7,700. So you add it. This would be the revised base cost. That means you can defer this much of gain. It will be rolled over. It will not be taxed now. Because 7,700 you have used to restore the asset out of the insurance proceed of 8,000, and this 2,000 is from the cost 8,000 you have received the proceed. Together, this would be the base cost. So let's summarize this lecture. Variations to computations. We started from transfer between spouse, no gain, no loss transfer. And if it's a part disposal, you have to consider the small part disposal, deduct the sale proceed from cost. Otherwise, allowable cost is adjusted. Then we have chattels and vesting asset. Chattels, vesting chattels are exempt, non-vesting are chargeable. Vesting assets, consider movable plant and machinery. Okay, you have to apply the rules of non-vesting chattels. If it's movable plant and machinery, it's chargeable. Immovable plant and machinery, allowable cost is adjusted. And other vesting assets like leases, intangible assets, they are vesting assets. Then leases. If it's a long lease, normal computation. If it's a short lease that is less than 50 years or 50 year, you have to adjust the allowable cost by the period of ownership. Then insurance and compensation. Insurance proceeds received, and you have to see whether the proceeds are reinvested or not, and whether they are reinvested fully or partially. If it's fully reinvested, fully you can defer the gain. If it's partially, then partially it will be chargeable, partially it will be reinvested. Do go and check when the asset is damaged, asset is lost or destroyed. Thank you very much for watching this lecture, and I will see you in the next lecture once again with CGT, where we'll be focusing on shares, disposal of shares and other securities. So thank you, and don't forget to subscribe to my channel. If you haven't subscribed, please go back to my ATX playlist and do check all the previous lectures that you have missed out. Thank you, and I shall see you in the next lecture.